All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of these. Nothing in this podcast or any of our other material should be taken as investment advice. James or I could have investments or positions in any of the stocks that we mention in this podcast, and we reserve the right to change those positions at any time without notice. So make sure you do your own work and consult a professional before making any investment decision. So with that being said, the topic of today's podcast is going to be Rivian. So last week, VW announced a big deal with Rivian to invest over $1 billion into the company. This news was taken very positively by the markets. However, we talked about Rivian in the past on previous episodes on our main channel, Wall Street Millennial, talking about some of the uphill battles that it's facing as it looks to the future and looks to achieve its operational goals. So in today's podcast, we're gonna dive into this VW deal and see whether or not how good it actually is for Rivian. If you'd like to support the work that we do, it'd mean a lot if you could check out our website, differentiatedanalytics.com, and consider subscribing. On this website, we provide professional-grade quality, full short-selling research reports, as well as access to our Discord server where we talk about investing ideas. Currently, we're running a promotion where if you use the code WSM50, you can lock in a 50% discount at checkout, and that would bring you the total cost to $10 per month. So with that, I'll hand it over to you, James, to talk about Rivian and this new deal.
Yes, so as Ryan alluded to earlier, we've been talking about Rivian on our main channel, Wall Street Millennial, since it went public back in 2021. You can see this video we published over here right after the IPO, talking about how absurdly overvalued it was. Since then, we've also released 2 other videos talking about the horrible financial results that Rivian has posted since then, in the massive amounts of money that they lose on every car that they sell. We've linked all 3 of these videos in the description below. So if you want some more background information on Rivian, you can check those out. But for today's video, we're going to be focusing on the Volkswagen partnership. So on June 25th, 2024, Rivian announced that they had secured up to $5 billion of investment from Volkswagen, but only $1 billion of that was paid up front. The remaining $4 billion could be paid over the next 3 years. Now, this news was viewed as being very positive. So prior to this investment being announced, Rivian's stock price was about $12. Immediately after, it went up to more than $15. Since then, it's tapered off a bit, but it's still as of the time of recording this video, it closed at $13.40, which is substantially above where the stock was before the deal was announced. So, this $5 billion investment from Volkswagen investors, the market as a whole has viewed this as a very good thing. But it's important to dig down into the weeds and see what exactly are the terms of this investment from Volkswagen. So the investment of $5 billion, it is split up into 5 tranches of $1 billion each. So only the first tranche has already been paid. The future tranches are in the future and may or may not even happen. But the first tranche of the $1 billion is a convertible note with a 4.75% interest rate that matures in 2026. So it's a 2-year convertible note, and it can convert into equity after December 1st, 2024. So that's just, like 5 months from now. In 5 months, it can convert at a price of $10.83 per share. So as of the time of recording this video, the share price is $13.40. So this convertible note is in the money. So it will, if the share price stays where it is, this $1 billion convertible note will convert into Rivian equity. So that's the first $1 billion. And then the next $1 billion is going to be related to a joint venture. And in the fourth quarter of this year, Rivian and Volkswagen will be creating a joint venture that will develop software and electrical architecture for electric vehicles. And presumably both Rivian and Volkswagen will use this jointly developed electrical architecture and software in their respective automobiles. And then because it's a joint venture, presumably both companies would have to pay money to the joint venture, maybe like a royalty for each car that they sell for using intellectual property created by the joint venture. But this is going to be, happening years in the future because, the joint venture is just being created now. It's going to be a few years before this joint venture develops any software or electrical architecture. And then in 2025, there's going to be a $1 billion investment into Rivian equity. So that's just going to be Volkswagen buying new shares of Rivian stock. And then there's going to be another $1 billion equity investment in 2026. And then they say that both of these equity investments will be priced based on the 30-day trading volume weighted average price of Rivian shares prior to the dates of the investment. So it looks like, these investments will just be priced based on whatever Rivian stock happens to be trading at that time. And then finally, in 2026, Volkswagen will lend $1 billion of debt to the joint venture. That's the joint venture they're going to create to jointly develop software and electrical architecture. Now, only the first tranche has been paid. The next 4 tranches are all subject to undisclosed milestones that Rivian and the joint venture have to meet. Volkswagen is going to be continuously looking at it and seeing, okay, is this joint venture actually working out? Is it actually creating software and electrical architecture that we actually want to use in our VW cars? And only if they're happy with the progress will they follow through with the further tranches. So at most, Rivian is going to get $5 billion. But we don't, it's not yet guaranteed. So why does Volkswagen want to make this investment in Rivian? So the main reason is because Volkswagen has historically, over the past 2-3 years, had huge problems with their software and electrical architecture, specifically related to their electric vehicles. So, if you look at this article here from The Verge in 2022, they're talking about how Volkswagen is having problems with their software. The software within their electric cars is glitchy and bad. And then Volkswagen owns a subsidiary called Cariad, which they try to develop, which they use to develop their software internally. It's been kind of a disaster and is losing a lot of money. So Volkswagen has been having a lot of trouble developing its own software and electrical architecture, while Rivian, on the other hand, has been much more successful, at least in terms of the software. So upon the completion of the joint venture between Volkswagen and Rivian, Volkswagen would receive immediate access to Rivian's current electrical architecture technology for using in its electric vehicles. So the Volkswagen will immediately receive Rivian's existing electric architecture. That's before the joint venture even develops any new electric architecture. Volkswagen already gets access to Rivian's electrical architecture, which is hugely valuable to Volkswagen. And what is the electrical architecture? That's basically all of the wiring and computers within the car that control all the electrical components and the battery and everything within the car, and that's tied to the software. So if Volkswagen gets access to Rivian's electrical architecture technology, presumably they will also get access to Rivian's software. And since Rivian software has been much more successful than Volkswagen software, this is a huge benefit to Volkswagen. And that's really why Volkswagen made this investment into Rivian, because they wanted to get access to Rivian's software. Now, the problem from Rivian's perspective is that Volkswagen is a competitor to them. And specifically in 2026, Volkswagen is expected to release their new Scout electric SUV, and there will also be a Scout electric pickup truck, both released in 2026. And the Volkswagen Scout is expected to be a direct competitor to Rivian's R1T and R1S. So by accepting this investment from Volkswagen, Rivian is effectively giving intellectual property, specifically their software and electrical architecture, to their direct competitor. So in my opinion, this investment, the fact that Rivian accepted this investment from Volkswagen is really a sign of desperation, because they're so desperate for cash that they needed to basically give up a lot of their intellectual property to a direct competitor who's going to be competing with them with an extremely similar automobile in 2026, just in order to get the cash. So, really the only thing Rivian is getting out of this deal is the cash. In terms of, like software and electrical architecture, Volkswagen doesn't really have anything to offer Rivian, given that Volkswagen has had so many problems with their software in the past. Volkswagen is pretty much incompetent when it comes to software and electrical architecture. So they have nothing, to offer Rivian. The only thing Rivian is getting out of this deal is cash, while Volkswagen is actually benefiting from Rivian's software and electrical architecture. And this investment from Volkswagen in the joint venture has nothing to do with manufacturing or production. So Rivian still has the same problems they've always had of their inefficient production and the fact that they lose tens of thousands of dollars for every car that they sell. Now, if you watched our previous video about Rivian on our main channel, Wall Street Millennial, we analyzed the their absurd path to gross margin break even that they advertised in their Q4 2023 investor letter. At the time, we said that this, that their graph was absurd, because they claimed that throughout 2024, their revenue per vehicle sold would increase by 15%. And at the time, we said that this was absurd because in Q1, they just released their standard battery pack, which is $9,000 cheaper than the regular battery pack. So the introduction of this cheaper model will cause the average selling price to decline. So revenue per unit will almost certainly be lower in the fourth quarter of 2024 instead of 15% higher as they advertised. Well, when we released that video, they had not yet released their Q1. They had not yet released their Q1 earnings results. Now they have, so we can look at that and see how things played out. So exactly as we predicted, Rivian's revenue per vehicle sold indeed decreased from the fourth quarter of 2023 to the first quarter of 2024. And that's because of the introduction of the cheaper standard battery pack. Now, if we look at their path to gross margin break even, they said that between Q4 2024 versus Q4 2023, revenue per unit will increase by 15%. And the revenue per unit was about $94,000 here. So if it were to increase by 15%, it would have to be at $108,000 here. In Q1 of 2024, after the standard battery pack was released, the revenue per car sold was only $88,000. So how are they going to get from $88,000 per unit sold all the way up to 108,000 per unit sold, because that's what they're claiming in their in their gross margin break-even chart that they provided back here. So where is this $20,000 of revenue per car going to come from? Well, in a separate investor presentation, which they just released recently in June of this year, it was just a few days ago that they released it, they reiterated their guidance that they're going to achieve positive gross profit in Q4 of this year. And here, they don't give a percentage of how much their revenue per unit will increase, but they say that their revenue per unit will increase because of regulatory credits and remarketing. So what are regulatory credits and remarketing? So regulatory credits are, in some states, there are these, they have these programs where all automakers need to sell a certain percentage of their automobile sales need to be electric. And for automakers like Rivian, 100% of their, so say hypothetically, the cutoff is 30%. So you need to have 30% of your automobile sales are electric. And then say hypothetically, well, Rivian, obviously, all of their vehicles are electric. So they're, way above the threshold. And then, but for a legacy automaker, maybe only 10% of their sales are electric. So they're 20% below the threshold. Well, that automaker will have to buy credits from Rivian to achieve regulatory compliance. And that's, a source of revenue for Rivian. And then remarketing, what that is Rivian has a program. They offer a service where you can trade in your existing vehicle for credit towards buying a Rivian. So say the Rivian, it cost $80,000. Then you have you have a Ford F-150 or any random car that's worth $20,000. So you can give that car to Rivian, and then they give you the value of that car as a credit, which is subtracted from the purchase price of the Rivian that you're buying. And then they sell it into the used car market, and they recognize that as revenue. And they call that remarketing revenue. But it's not really, a huge profit driver because, whether you paid $80,000 for the Rivian or you gave them, a $20,000 car and then you paid them the $60,000, it doesn't make a huge difference towards the economics, but that's technically a piece of revenue, which they claim will increase. And that's going to increase their revenue per unit delivered. They haven't really given any information as to why the remarketing would cause revenue per vehicle to increase, because it's basically just offsetting the purchase price. They didn't really explain this portion at all, because, this is a program that they've been offering, for a long time. I don't see what's going to change about it that's going to give them some huge boost to revenue per unit by the end of this year. But then specifically on the regulatory credits, they generated $73 million from the sale of regulatory credits in 2023. And if you divide that by the number of vehicles they sold that year, they generated $1,500 per vehicle for the sale of regulatory credits. And I don't think there's any changes to the laws or any reason why you would expect regulatory credits to massively increase this year. So how is this they haven't given any convincing reason to bridge this gap, how they claim that their revenue per car sold is going to increase by $20,000 over the course of this year. Because the regulatory credits, why would that even increase? And it's tiny. It's $1,500 a car compared to this $20,000 increase that they're guiding to. And the remarketing, as I said earlier, this is something that they've done for a long time. Why would the remarketing increase by $20,000 over the course of this year? And given that, this 15% is absurd, that they absurdly include this 15% revenue per unit increase in their chart here, why should we believe any of their other numbers? So we can just think logically and look at, what's actually happening and see that, this piece of it is absurd. Well, as far as, they claim they're going to get this massive benefit from their fixed and variable costs we as outsiders, not being within the company, we don't know if that's true. They claim that they're, reworking the design of the car and making everything way cheaper and way more efficient. That's what they claim. We have no way of independently verifying that. But why should we believe anything they say when the one thing that we can verify, this revenue per unit, is moving in the wrong direction? And it makes absolutely zero sense how they could make their target year. So I think this is all just a giant house of cards and a giant charade, and they're continuing to double down on it. So I'll be very interested in seeing the proof will eventually be in the pudding as they report earnings in Q3 and then Q4. We'll see whether or not they can actually achieve positive gross profit. Based on everything I've just been talking about, I think this is extremely unlikely. And then just a reminder, they lose a huge amount of money. So in the first quarter of 2024, they lost almost $40,000 per car. They're claiming that they're going to get that to they're going to get that to break even by the end of the year. Yeah, as I said earlier, I don't believe them. And then finally, on the issue of liquidity. So really the only benefit that Rivian got from this Volkswagen deal was the $5 billion of extra liquidity over the next 3 years. But while $5 billion sounds like a lot, and remember, it's up to $5 billion based on undisclosed milestones. But let's just give them the benefit of the doubt and say that, and assume that they actually are gonna receive the entire $5 billion from Volkswagen. $5 billion sounds like a lot of money, but compared to how much Rivian burns, it's not even that much. Because in the most recent quarter alone, Rivian burned $1.5 billion. And if you annualize that, they're burning money at a rate of $6 billion per year. So that $5 billion that they're going to get from Volkswagen over the next 3 years is less than 1 year of cash burn at the current rate. And not only that, of that $5 billion from Volkswagen, $2 billion of it is going to the joint venture. So that money has to go to funding the joint venture and the research and development they're going to do on their electrical architecture that they're developing. So that's not necessarily, I don't think that's money that Rivian can spend on its own operations. So it's really, they're only getting $3 billion in direct corporate investment, which is, only half a year's worth of cash burn. So they're not actually getting that much money compared to how much they burn. If you look at this chart, which shows their cash and equivalents since going public, when they went public, they raised a huge amount of money from their IPO. So they had $18 billion right after they went public. And then now, 2 years later, that has declined to $8 billion. So they've burned $10 billion over the last 2 years. Actually, no, their cash has declined by $10 billion over the last 2 years, but that includes them raising $3 billion worth of convertible notes. So they've actually burned $13 billion over the past 2 years. And then, okay, they're going to receive, $5 billion over the next 3 years. Well, I mean, they're going to burn through that pretty quickly as well. And I think it's going to be sooner rather than later that they're going to have to come, tapping the capital markets again for even more funding. And another thing is, as Rivian's share price declines, whatever equity raises they do are going to be more and more diluted. So, for example, the $3 billion of direct investment they're getting from Volkswagen, the $1 billion convertible bond, and then the $2 billion of equity investment. At current prices, if you add all those together, that adds up to more than 20% of Rivian's shares outstanding. So Rivian's existing shareholders are going to be diluted by more than 20%, as a result of this investment. And it's only giving them, half a year's worth of cash burn. So as the share price of Rivian has declined, but they're still burning a huge amount of cash, whatever equity raises that they do are going to dilute shareholders faster and faster. And with Rivian still being, many years away from profitability, this is not a good situation, in my opinion.
To play devil's advocate real quick here, James, I don't think anyone would argue that Rivian's senior management are dumb, right? Like to be able to create Rivian into a company that actually is able to produce a very high quality car when so many other EV startups couldn't even end up selling a single one before they ran out of money. Like these are obviously capable, smart people. So then why would they be willing to do such a seemingly mediocre deal with VW in terms of the terms that they get for the investments and giving the intellectual property to a direct competitor? Like what would the reasoning be to agree to a deal like this?
Well, I think the reasoning is that they're desperate, basically. So, they're running out of cash. So when they did this deal, they had about $8 billion of cash on their balance sheet. They also have a bunch of debt that's coming due in 2029 and 2030. But, that's a few years away. They had $8 billion. But, as I said earlier, they're burning cash at a rate of $6 billion per year. So within, less than 2 years, they're probably run out of cash. So they need to raise capital. And by partnering, if they just went onto the open market, if you look at their previous issuances of convertible bonds in last year in 2023, they issued two convertible bonds. I think one was in October, the other was in like February, I think. Both times when they announced the issuance, their share price tanked by like 10 or 20%, because investors never like to see a company raising capital. Now, in the case of this Volkswagen deal, the opposite happened. When they announced the deal, the share price increased massively. And so because they're able to spin it, and they released, upon them announcing this Volkswagen investment, they released a fancy presentation talking about it, and they did a webcast hyping it up. And then they can sort of spin it as saying, oh, this is a huge vote of confidence from Volkswagen that they believe in our technology, and we're going to do a bunch of work with them with this joint venture and create, even better software and electrical architecture. There's a lot of ways that they can spin it, which maybe sounds better to a lot of investors. But if you actually look at the reality, it's just a way for Rivian to raise capital because they're running low on cash and desperately need the money. So it's really a deal of desperation. But I guess when you add a JV to it in a partnership, that sounds better than just saying like, oh, we just, diluted our shareholders a ton. So that, I think, wraps it up for, everything we had to talk about Rivian today. As always, if you have any thoughts on Rivian, please let us know in the comment section below, and we will see you all on next week's video.